Good morning, and welcome to episode 279 of Getting Rich. I'm your host, Rich Checkin, president of Asset Strategies International, and today is Wednesday, June 3rd, 2026. Russian attacks on civilians in Ukraine escalate. Meanwhile, the U.S. vows to extend the nuclear umbrella in Europe, calming NATO ally fears. The U.S. and Israel are at odds with their next steps with regard to Iran. Prime Minister Benjamin Netanyahu is receiving significant backlash for not following through on bombing Hezbollah targets in Beirut. Meanwhile, given our fragile ceasefire, President Trump is suing for peace with the Iranians. And that happens even as the U.S. and Iran exchange missile fire overnight. Well, next week we'll see new Fed Chairman Warsh host his first Federal Open Market Committee, or FOMC, meeting. Most believe that rates will remain unchanged at this meeting, although most also believe that by the end of this year we will start to see rate increases in response to sticky inflations and high CPI and PPI numbers. Over the past week, gold and silver remained fairly steady, virtually unchanged. Let's go ahead and take a look at the precious metals prices for the past week. Gold is up 0.3%, trading today at $4,459.10 an ounce. It was $4,445.50 last week. Silver is virtually unchanged, trading at $74.48 an ounce. That's up 3 cents from $74.45 last week. Platinum is up 0.2%, trading at $19.31 an ounce, up $3 from $19.28 an ounce last week. And palladium is down 1.4%, dropping $20 to $13.74 an ounce. It was $13.94 an ounce last week. With gold slightly outperforming silver, it's going to take more ounces of silver to buy that ounce of gold. Your gold-silver ratio ticks up slightly to 59.87. It was 59.71 last week. And the dollar showing just a little bit of strength, but staying below that critical $100 mark on the legacy index against major currencies, trading today at 99.33. It was 99.13 a week ago. So the Financial Times reported today that gold holdings by central banks for currency reserves exceeds U.S. Treasury holdings by central banks. Folks, I believe this is actually old news, but glad to see it's getting some press from the Financial Times. It's what I've been saying all along. The central banks understand the issue. They understand about debt. They understand about overspending. They understand that central banks around the world are not helping their cause by expanding the money supply, inflating their currency, and having an impact on consumer prices worldwide. As a result, they have made a move to gold as a tier one asset to protect their economies, to protect their countries, to protect their currencies. Gold is the only real answer to mismanaged fiat. When you have fiscally irresponsible governments, gold is your antidote to that venom. And I suggest strongly that you take advantage of it. Gold and silver will not stay at these depressed prices for long. We're seeing lower spot prices than they ought to be. We're seeing lower premiums for bars and coins than we ought to. That's a great combination for those looking to accumulate. I suggest you do so here. You will be glad that you did in the end. Want to let everybody know that we are looking forward to our next webinar, our next episode of On the Move with my co-host Adrian Day. We will be welcoming Mark Thornton of the Mises Institute at 7 p.m. Eastern Time on Wednesday, June 17th. We'd like you all to join us. You can go ahead and register for that webinar in the comments section below in the description paragraph. In the meantime, before we get to that point and we have a chance to talk with you about sound money and how to get through this current economic climate, I want to remind you that, as always, we'd like you to go ahead and follow us on YouTube. Send us your comments and questions, like us. Go ahead and take our social media, our twice weekly, always something interesting alerts, and our once monthly information line newsletter, which comes out tomorrow. But in the end, don't ever forget, getting rich starts with keeping what's yours.